I tested 15 indicator strategies. Here's what actually works. If you've ever searched for trading strategies online, you've probably seen hundreds of indicators. RSI, MACD, moving averages, stochastic, Bollinger Bands. And every video claims their indicator strategy has a 90% win rate. But here's the actual problem that most traders face. Most traders stack 5, 10, sometimes even 15 indicators on their charts. And instead of making trading easier, it actually makes it more confusing. So I decided to test something. I backtested 15 popular indicator strategies that traders commonly use. Some of them worked, some of them failed badly, and a few strategies actually surprised me. In this video, I'll show you how to add these indicators on your chart, when to enter a trade, where to place your stop loss, where to take profit, and most importantly, which strategies beginners should actually use. Let's get started by setting up our charts properly. In this section, I'll show you how to add indicators. Before we test the strategies, you first need to know how to add indicators. I'll show you the easiest way using TradingView because it's one of the most popular charting platforms. When you open your chart, look at the top of the screen. You'll see a button called Indicators. Click it. Then, simply type the name of the indicator you want. For example, RSI, MACD, Moving Average, Bollinger Bands. Once you click it, the indicator will automatically appear on your chart. You can also adjust the settings by clicking the gear icon beside the indicator. This allows you to change things like indicator period, colors, and signals. Now that we understand how to add indicators, let's start testing the strategies. Strategy 1, the moving average crossover strategy. The first strategy uses the moving average indicator. This is one of the most famous trading strategies in the world. To add this strategy, open the indicators menu and search for moving average. Add the indicator to your chart twice so we can configure two different periods. Open the settings for the first one and set the period to 20. This will be our fast moving average. Now, set the second one to a 50 period. This acts as our slow moving average for trend confirmation. Now here is how the strategy works. It all comes down to the crossover. When the 20 moving average crosses above the 50 moving average, this signals a potential uptrend. You can enter a buy trade after the candle closes. Place the stop loss below the previous swing low and set your take profit at twice the distance. When the 20 moving average crosses below the 50 moving average, it signals a potential downtrend. Enter a sell trade here. Place your stop loss above the swing high and take profit at 2 times the risk. Let's look at a specific example on Bitcoin. Notice this crossover here. Following our rules would have captured this entire trend. During testing, this strategy worked best in trending markets, but during sideways markets, it produced many false signals. Now that we've covered moving averages, let's move on to our second strategy. Strategy 2 is the Relative Strength Index, or RSI reversal strategy. Next is the Relative Strength Index, also known as RSI. RSI measures whether the market is overbought or oversold. Add the RSI indicator with the default setting of 14. When RSI falls below 30, the market is considered oversold. Wait for RSI to cross back above 30. Enter a buy trade. Place stop loss below the recent swing low. Set the target at the next resistance level. When RSI goes above 70, the market is overbought. Wait for RSI to cross back below 70. Enter a sell trade, stop loss above swing high. Target the next support level. This strategy worked well in sideways markets, but poorly in strong trends. Moving on to our third strategy, we have the MACD crossover. Next up is strategy 3, the MACD crossover strategy. Next, we tested the MACD indicator. MACD shows changes in momentum. Add MACD with default settings. When the MACD line crosses above the signal line, enter a buy trade. Place your stop loss below recent support and set your target at 2 times the stop loss distance. When MACD crosses below the signal line, enter a sell trade. Place your stop loss above resistance and target the next support level. This strategy had moderate success, but still produced false signals in ranging markets. Next, we have our fourth strategy, Bollinger Band Bounce. Strategy 4, Bollinger Band Bounce. Now let's test Bollinger Bands. Bollinger Bands show volatility. Add the indicator with default settings. When price touches the lower band and starts moving upward, enter a buy trade. Place the stop loss below the lower band. Set your take profit at the middle band or upper band. When price touches the upper band and starts moving downward, enter a sell trade. Stop loss above the upper band. Target the middle band. This strategy worked best in range markets. Now let's dive into our fifth strategy, stochastic reversal. Strategy 5 is the stochastic reversal strategy. Add the stochastic indicator. This indicator helps us spot potential reversals by measuring momentum. When both lines fall below 20, the market is oversold. Wait for the lines to cross upward. Enter a buy trade. Place your stop loss below recent support and set your take profit at resistance. When stochastic rises above 80, wait for a downward crossover. Enter a sell trade. Stop loss above resistance and target the next support level. Now let's look at strategy 6, the EMA trend strategy. Add the 200 EMA. This indicator helps identify the overall trend. Add the 200 EMA indicator with default settings. When price is above the 200 EMA, only take buy trades. Enter when price pulls back to the EMA. Enter here. Place your stop loss below the EMA and target the previous high. When price is below the 200 EMA, only take sell trades. Look for pullbacks to the line. Enter your sell trade. Stop loss above the EMA and target previous lows. After testing all 15 strategies, something interesting appeared. Most indicators do not work well on their own. The strategies that worked best always had two things in common. They followed the overall trend and used support and resistance levels. Indicators alone rarely produce consistent profits, but when combined with market structure, they become much more powerful. If you are a beginner trader, here are 3 simple rules. Rule 1, do not use too many indicators. 2 or 3 is more than enough. Rule 2, always follow the trend. Trading against the trend is a fast way to lose money. Rule 3, always use risk management. Never risk more than 1 to 2% per trade. So after testing 15 indicator strategies, the truth is simple. Indicators are tools, but they should never replace understanding the market. If you enjoyed this video and want to see more trading experiments, make sure to subscribe. I'll see you in the next video.